And for more on this, we're now being joined by Amin Papare, founder and MD of Seya Forex live from Mumbai. Thank you so much for joining us on World Business Watch, sir.
Thank you for calling us.
I just want to begin by asking you, can you explain what the RBI's rule really means and its impact on the rupee and the country?
As far as hedging is concerned and total volume of the position is concerned, you can hedge. The volume is divided into three segments. First is an currency derivative segment, and another segment is bank. In the bank, you will have two parts, which is merchant trade and interbank trades. So total volume, a derivative segment only constitute 10 to 14% of the total volume of Indian currency market. Now, as far as hedger is concerned, hedgers can hedge in bank also, and hedgers can hedge in currency derivative segment also. Now, we have close to 500 clients all across India. And out of that, 85 to 90% of hedgers prefer to hedge in bank. Only 10 to 15% of exporter or importer will prefer to hedge in currency derivative. Currency derivative was giving them an alternative platform to hedge with cost efficiency, and they can definitely hedge after 3:30 when the bank gets closed. So it was an alternative platform for them, but mainly they used to hedge in the bank. Now with RBI's new circular, it is going to tend speculators and traders from entering into the market. And if you see all RBI circular, it is a clear-cut strategy from the RBI that RBI wants only hedgers to participate in currency, trading, currency activities. In 2020 also, RBI came up with a circular saying that if you want to hedge in the bank, there are only two provisions via which you can hedge. One is contracted exposure and one is anticipated exposure. That also clearly signifies that RBI wants hedgers to be in the market. That is completely fine. But the only problem with the recent circular is that in the derivative segment, 70 to 80% volumes come from traders and speculators. They are providing debt and liquidity to the market. If that is withdrawn, then it is going to have an impact on hedgers also, because liquidity will reduce, debt will reduce, and the cost of hedging probably in exchange will also increase. So if I were to be an RBI, then I will try to find a middle solution where hedgers should be there allowed, which is currently allowed, but traders should also be given some amount of limit, say $5 million or $10 million, like that. So it will provide a balancing act where an hedger is also there, trader is also there, and currency derivative segment is also alive.
All right, sir. Now, that being said, what does the delay in the deadline for the rule to May 3rd from April 5th mean? And why do you think the RBI postponed the implementation of this time frame?
Yeah, there are, you can see that regulation coming yesterday night as two agenda. That is a positive aspect. First is that RBI did not wanted market participants to get panicked. That is why RBI have extended 1 month window. Second, in the circular, they said they are going to evaluate it again, how effectively hedgers and traders can work. So we can say that, RBI has given a listening voice to all the stakeholders, and probably in 1 month, we are expecting some kind of resolution by the regulator to come in and clarify further what they want market participants to do at current scenario.
All right. Well, sir, thank you so much for joining us on World Business Watch with your insights on this.
Thank you.
For latest news, download the WION app and subscribe to our YouTube channel.